Under normal conditions, stock prices and bond yields maintain a predictable rhythm. They fluctuate alongside economic growth and policy shifts, but they generally move within a range that the market understands. That rhythm is breaking. Across global markets, equities have become highly reactive to yields. Every time bond rates tick up, stock prices are taking an immediate hit. It is a worrying echo of the year 2022, a time when previous assumptions about safe, perfectly balanced portfolios suddenly fractured. This negative correlation is pushing the market toward a cliff edge, leaving investors to identify exactly where the drop begins. To find that edge, we track the relationship through a specific metric, the 6-month rolling correlation between yields and equities. Looking at data from 1979, the current trend is a significant anomaly. The correlation is currently testing the lower bound of its historical range. It has reached a level of intense negative pressure the market rarely sees. This means that rising yields are no longer just a headwind. They're pulling down stock prices in a direct, inverse relationship. Simply observing the negative correlation isn't enough. To understand the risk, we have to define the mathematical breaking point. Two primary variables drive this tension: equities and the nominal 10-year Treasury yield. Analysis from Barclays identifies a specific threshold for this relationship. They mark the danger zone at 5%. As long as the 10-year yield consolidates below this 5% level, the pressure on stocks has room to abate. This 5% mark is often treated as a definitive safe limit, but that perspective creates a false sense of security by ignoring a third factor. The entire system is actually controlled by a third variable, core inflation, or core CPI. Currently, this inflation gear is registering below 3%, which keeps the system in its current alignment. The 5% yield threshold only functions as a safety net, while core CPI remains under that 3% mark. If inflation moves above 3%, the mechanical link shifts. It forces the danger zone for yields to drop. Historically, when inflation reflates, yields start to pressure stock prices at levels well below the 5% threshold. The inflation level dictates when bond yields become toxic to stocks. This three-variable framework provides a clearer outlook for the current market. For stocks to remain stable, the 10-year yield must stay below 5%, while inflation stays contained. This creates a highly precarious balancing act, where equity valuations remain constantly reactive to any sudden gusts of inflation data. Any continued stability in the stock market depends on these two specific macroeconomic metrics holding steady. This framework shifts how we evaluate market risk over the long term. The market operates as an interconnected system. Stock prices, bond yields, and inflation data move in a linked progression. Predicting stock movements now requires constant attention to the 10-year yield and the core CPI gear. This video is provided for financial analysis purposes only and should not be considered as investment advice.